There's talk of recession in the air, so I've got 3 recession-proof stocks to fortify your portfolio. Hi everyone, I'm Marc Lichtenfeld, author of Get Rich with Dividends, and this is your weekly State of the Market. Inflation is surging, markets are tanking, and the whispers of a coming recession have turned louder. So what's the plan? Are we selling all of our stocks?
Give it back! Give me back the money!
Michael, behave!
Stuffing the mattress with cash and burying the gold in the garden? Hiding beneath the covers until the talking heads give the all clear? Yes, that's exactly what you should do. Have you seen it out there? It is scary.
Tomato.
Come on, that's exactly what you shouldn't do. At times like this, remember the expression, there's always a bull market somewhere. You've just got to know how to find it. Today, I'm going to tell you where I expect the bulls will hide if the US slides into a recession. But before I do, I'm going to ask you to do something for me. Don't worry, it's quick, painless, and free. Just click that subscribe button. Not only will you boost my numbers and help these videos reach more people, you'll never miss my free investment guidance again. Okay, let's get to it. My first recession-proof stock is a familiar face with a large blue body, Walmart, ticker symbol WMT. Some people like to sneer at Walmart and their customers' unconventional wardrobe choices. But value retailers are a lifeline for the American consumer during times of relative hardship. Walmart's entire model is based around offering customers the lowest price possible, and that prospect is never as attractive as during a recession or periods of high inflation. At a time when most companies are struggling to just stay afloat, Walmart is doing backflips in the deep end. During the last recession, that quick blip during the early days of the COVID pandemic, shares of Walmart rose 4.5%, while the overall market dropped nearly 14%. More impressive still, during the Great Recession of 2008, shares of Walmart grew 1.5%, while the S&P 500 slipped 38%. And at one point, Walmart had climbed 34% before gradually slipping over the next 9 months. And that doesn't include the dividend, which added another nearly 2% per year. So that's not too shabby. Next up, and sticking with our good times rolling theme, we've got a defense contractor. You know, wars have a funny way of popping up during times of economic hardship. It's one of the best ways to distract citizens from how miserable everything else is.
Squirrel!
In fact, bear markets are excellent predictors of war. The market was already in a bear market when 9/11 occurred, and shortly after, we went to war with a country that had nothing to do with 9/11. We were still in Iraq and Afghanistan during the bear market of 2007 to 2009, so we didn't need to start a new war. Now, wars don't happen the minute a country's economy hits a snag.
Gentlemen, you can't fight in here. This is the war room.
Like Marvel movies, invasions and annexations require a lot of planning.
Let's have a word! We can all use the money!
For example, Russia's GDP fell 3% in 2020, but they didn't manage to get their war off the ground until February 2022. Now, our regularly scheduled war is probably still a ways down the pipeline, but last time I checked, the world isn't getting any safer and defense budgets aren't getting any smaller.
Yeah, weird, isn't it?
Now, hopefully we're not paying $800 for tactical toilet seats anymore, but defense missiles, kind of important. That's why my second pick of the week is defense contractor Raytheon Technologies, symbol RTX. Besides missiles that can vaporize you from the atmosphere, Raytheon makes defense systems, flight systems, is involved with cyber defense, spaceflight, and much more. And with things going the way they are going, earnings are forecast to grow 20% next year. What's more, Raytheon is a perpetual dividend raiser, having boosted its dividend 18 years in a row and currently pays a 2.4% yield. Now, last but not least, healthcare is a sector you absolutely want to be invested in during a recession. People will cut corners when times get tough, but they have to keep taking their medicine. That's where pharma company GlaxoSmithKline comes in. GlaxoSmithKline sounds like the love child of a cult leader and an underwear model, has a major event coming up. The company is spinning off its consumer products division, simultaneously beefing up its balance sheet and allowing it to focus on medicines and vaccines. It currently holds the rights to dozens of prescription medicines such as household names Advair, Flonase, and Levitra. Yes, that Levitra. It's also the largest vaccine maker in the world, with the bestseller Shingrix for shingles, vaccines for HPV, flu, tetanus, measles, mumps, meningitis, hepatitis, all the itises really. Glaxo is based in the UK.
Fetch us a cup of tea.
So shares for sale in the US are what's called American Depository Shares, or ADS. These are just equity shares of a non-US company held by a US bank to make them available for purchase by US investors. Last quarter, each of Glaxo's ADS received a 60-cent dividend, which translates to a juicy 5.7% yield. And that should help buffer the stock from a downturn in the economy or even a decline in the stock price. So there you have it. Cheap stuff from China, missiles, and drugs. Everything your portfolio needs to withstand a recession. I'm Marc Lichtenfeld, and this has been your State of the Market. For more wealth building and recession-proofing tips like these, click the link in the description and sign up for my free daily e-letter.